In this video, we're going to be discussing why, when building a portfolio of expert advisors, you should try and combine different styles together, both trend following and more short-term breakout style bots. And we're also going to dive into Quant Analyzer to prove why using a more diversified approach is generally better. So here you can see a nice daily chart of the DAX, and you can clearly see that there are different market regimes. There are periods where it's more slowly trending upwards. There's these crazy sell-off periods. This was more like the Liberation Day sell-off. And then we also have more choppier periods of consolidation. And effectively, in these different market environments, different strategies will do better. If you're in a very strongly uptrending period, the absolute best thing you can do is just buy and hold with leverage and essentially be along for the ride. If you're in a period of crazy volatility, something which is more of a breakout system will likely work best because you can have these explosive moves to the downside. If we were to zoom in, for instance, on some of these past days more in April, if I can kind of zoom a little bit over, we can see that we have these very momentous downward shifting days or these momentous upward shifting days. And these very strong impulses generally lend themselves well to more breakout style systems. And if we go over to more of the recent price action, it's more ranging. And this is a period where perhaps either more shorter breakout scalper systems or even certain types of more trend following on a shorter basis would work well. However, on some days, more of a mean reversion system may also work well. So if you build a portfolio of EAs, if you don't want to have to constantly keep adjusting them, putting together a variety of different bots, some which are long trend following, some which are short trend following, some which are more breakout, and some which are perhaps more mean reversion, kind of works well, and you can kind of have the most diversified equity curve. So right now what I wanted to do is show a couple of our bots, and specifically we're looking at three different ones. We're looking at German Longbow, American Longbow, and German Orb Fund. And these are all very interesting bots as they work on combining fundamental data with technical data. So the actual triggers here are all based on options data. So they're looking at put-call ratios to assess whether or not a day is more likely to be bullish or bearish. And specifically German Longbow and American Longbow, longbows, they focus more on entering at the beginning of the day, and I'll go to the 1 hour, and they would enter here at the beginning of the day, and they aim to hold until the majority of the day is over and capture that full daily range. The Orb Fund, as the name would suggest, are more opening range breakouts, so they would look to enter at the open of the German market, which is usually 10 o'clock, and they would then capture a breakout of that time. The main difference between our Orb Fund and just a normal EA is they actually use an options filter to know if they're going to go long or short. But I digress. These are all very advanced EAs which use fundamental data to make trading decisions. However, some of them are based more on market entries and are meant to capture longer daily ranges, whereas others are based more on shorter movements and more less long hold periods to capture an impulse at the open. And we can look at some of the equity curves here in Strategy Quant. Let me look at the individual ones. You can see this backtest is from 2022 to July of this year, and it's a nice kind of a high risk reward style equity curve. American Longbow looks pretty similar, and this is usually characteristic of more of a high risk reward bot where you have these jumps which are indicative of those big winning days, and then when you have a losing period, usually they're these pretty small runs of losers followed by big jumps up. Orb Fund here, this is more of a scalping style equity curve, so you can see that you don't have those same jumps in how they look. This actually is a positive risk reward bot, so this looks more like a 1-to-1, where you have equal wins and equal losses, so they kind of balance each other out. But the reason why it's helpful to combine different strategies is really when it comes down to a portfolio basis. So here you guys can see that we combine two of the different longbows together, American Longbow and German Longbow, and it gives us this nice blue equity curve. And what I want to show you here is that we now have a profit factor of around 1.33 and a strategy quant quality number of 3.8, which comes from Van Tharp's numbers. And one thing to note is that it's not the perfect comparison between these two portfolios because the risk level is a bit different, but I really want you to kind of zoom in on profit factor and strategy quality number. And you can see it's nice and consistent. We have some losing months, some winning months, far more winning months, but on average, over a long enough period of time, you do super well. And this goes to show that in real trading, you can have a month which is red. It happens, right? Particularly when you don't have more of a great martingale. And it's just something which one would effectively need to expect. But if we jump over here now to a different portfolio, here we're actually combining a German Orb fund with American Longbow. So the two differences here is in one we're doing American Longbow, German Longbow, and one is American Longbow, German Orb fund. And really the point of this video is that even though German Longbow and German Longbow and German Orb fund trade the same thing, because your entry is different, you're adding a different level of diversification. And what you can see, we go to the portfolios, we have Longbow only, we're more likely to be hit by these more choppy periods. Like for instance, this year when we had some more bearish price action, it essentially did hit us a little bit there. And let me see if I can pull up my chart again here. We can see that, for instance, in February and March, we kind of, here we go, we kind of entered this more like choppy, a little bit more bearish price action. We didn't do quite as well because we got two different longbows running together. But if we were running more of an orb, that price action, as you can see here, would have actually been super, super good, because although we had a bit of choppiness, I think it was the German election actually that caused that, there was a lot of volatility at the open, and this led to very good results for more of an orb. And what you can see is that if we compare the profit factor for two longbows, we're at 1.33, and if you compare it for two orbs, we're at 1.51. Some of the drawdown metrics here are a little bit different because the risk percentage is a bit higher for longbow plus for the orbs, pardon me. So that is skewing it, so that's why it might look a bit odd that the drawdown goes up. It's to be expected when you just increase the risk. The more important factor here to look at is the profit factor. So what this goes to show is that by combining different entries, even if the asset is the same in both scenarios, you can actually have a higher quality strategy because you're able to be more robust across market regimes. So this was a bit of a long winding video, but essentially my point was it's helpful to, even if you're diversifying across assets, to also diversify across entries, because then you're even less susceptible to different market regimes. Because as long as there's one of the strategies that does well, it should be able to kind of smooth out the broader equity curve. So guys, hope you enjoyed the video, and I'll see you in the next one.